Good evening, everybody. Hope everybody, Octavia, I'm going to have to mute you. I'm getting feedback from you, buddy. Thank you. Good evening. I hope everybody is well this evening. Our midpoint of our corporate finance class for this summer term. 5 weeks done, 5 weeks to go. Our agenda tonight is mainly concerning capital budget analysis. Now, I'm going to assume one big thing about this evening. In order for you guys to be in this class, you should already know about capital budgeting analysis. Net present value, internal rate of return, payback. You should already know that. If you don't, then you have to let me know, because I'm going to assume all that when I show you our review spreadsheet for this evening. What we're going to talk about is mainly risk analysis in capital budgeting, sensitivity and scenario analysis for risk. These things you probably not have covered in your previous finance or accounting courses. So I'm assuming everybody knows what I mean by net income plus depreciation minus working capital plus salvage value all equals your net project cash flow. Cost of capital is your discounted interest rate to determine the net present value to the investment in year zero. I'm going to assume you all know about this, because I'm going to go ahead on that, because I'm going to give you not a case this evening, but a case in a couple of weeks that's going to imply that you already know about that. So if you do not understand this or remember it or have a difficulty, now's the time to give me a shout out this evening, or give me a shout out in the next week or two, because that's going to be my basis for where we study out of this section of the course. Okay, so don't anybody come back to me in 3 weeks and say, I didn't know what the hell you're talking about. Now's the time to let me know you don't remember capital budgeting analysis, because we're going to talk about the risk side of capital budgeting analysis, sensitivity and scenario. We'll look at a spreadsheet that shows all this in our lecture this evening. Also, we'll take a quick view of the grades and the work for case number 1. I was very impressed with your analysis, with your work. It was very strong, very good. I'll take a look at a couple of the key points on how I assessed your work in this case. We're also going to talk about case number 2, which has been posted today. Here's the good thing about case number 2. You have 2 weeks to complete it. 2 weeks, not 1. It is due on Tuesday, July 20th. It's a PowerPoint formatted case. Your work should be in PowerPoint or some type of PowerPoint type of file. And I'll talk about that in a few minutes. It's a financial statement analysis and interpretation of the company that you did in case number 1. So in case number 1, you did a credit evaluation of a company from your portfolio. In case number 2, you're doing a financial statement analysis of the company that you have selected. And we'll talk about that in a few minutes as well. But the good thing about this is PowerPoint, well, that's not a good thing, but you have 2 weeks to do it. 2 weeks. July 20th is the due date. So you don't have to go bananas this weekend or into next week. You have 2 weeks. For those students who are in my online 6:30 class, your work is due Tuesday, July 18th, Sunday, July 18th for case number 2, but it's to be a PowerPoint. Again, if any of you have no experience in doing PowerPoint, shame on us at the University of La Verne for not demanding that as a way of getting up to this level of your study. But if you do not, that's okay. You let me know about that, and I will make sure you explain to you what I'm be looking for and how to go about doing a PowerPoint format. Case number 1 was APA format, and you all did excellent in that format. A couple of you missed a little bit the abstract section of it. A couple of you were rewarded for giving me a table of contents, but on the whole, it was an excellent APA formatted paper by all of you. So that's where we stand here in week number 5, the midway point of our corporate finance study. Here's our Blackboard site. In case any of you are interested, and not too many of you should be because you all did so well on the case number 1, but some of you did get points taken off. And let me explain something to you, and probably some students are going to get all bent out of shape about this, but this is my philosophy. In certain types of cases, especially at this level, advanced MBA study, I very rarely give 100% on a score. To get a 100% at this level, you have to go beyond the call of duty and what I'm asking in the case. Go a little bit step further. Some of you came very close to that in this case, and I was very impressed. But hundreds are not an option for many of the grades in my class. Now you might saying, oh, that's not fair. No, I think it is fair because at this level, just like in the real world, you get compensated and get rewarded for your efforts if you go over 100% in your efforts. If you go over 100% in how you do things and how you lead people, that's when you get rewarded that type of compensation or grade. Same thing holds true, in my opinion, at this level. So getting 100 in this class is no small feat. But getting a 94 to a 99 is an A and good, excellent work. Okay, just so everybody knows that. If you go to the case study file folder in Blackboard, you'll see 2 things. First of all, I have provided a solution PDF to case number 1. Now, this is my interpretation of the work. Okay. If you want to get 100, you got to get pretty well close to this type of interpretation. Charts, graphs, extra stuff. Again, going over and beyond what is asked for in the case. How you present the file work is rewarded with 100. Just so you know that. Now, I know in the past, and I understand this, some students say, well, that's not really fair. What's going on here? Well, you know what? At this level, I'm pushing you to the max. Now you have an experience in that. Now going forward in our remaining case studies, if you want 100, you got to push yourself over the max. Give me something a little bit extra on your work. That's why I put in the question in case number 1. It was optional, but if you gave me the whack of the company, if you showed me some ingenuity of researching and going forward and calculating the whack of your company, you got rewarded for extra efforts and points. But I did put that as optional. You weren't taken, any points were not taken, but you, by doing the whack in that case number 1, was going over and beyond what I was looking for, and that's rewarded. So that's how that works. So here is a sample solution. Everybody had their own interpretations, their own style, and I respect that, and I grade that. And this is just another interpretation that I wanted to show you that you have of an APA format paper at this level of study. Case number 2 is an entirely different format, a PowerPoint format, a whole other different way of presenting information. Okay? That's the challenge. We did some writing, a paper format in the first one. In case number 2, we're doing a PowerPoint format. In case number 3, we're going to be doing a spreadsheet format. All different ways of presenting information and interpretations that is being asked of you in this course. Let me show you case number 2. Note it is not due until, in this case it says July 18th. It's for this class, it's July 20th. It's due in 2 weeks. You have 2 weeks to do the work. Okay, so just note that.
Professor,
Yes.
do we have anything that's due this week?
No.
On Tuesday?
No. The syllabus says that case number 2, the original syllabus says it's due this next Tuesday, July 13th, I believe. But as it says in our syllabus, the professor has the option and the right to change certain things. I want to give you an extra week to do case number 2. I don't want you to rush through it and do a half-assed job. I want you to have extra time. You take your time. I know we have some students traveling in the next few weeks, some work commitments, some family commitments, so a little bit extra time will help. Also, there are extensions available for this at the end, even at the end of 2 weeks if you need extra time. Okay, no graded work this week. This case is a financial statement interpretation and ratio analysis of the company that you selected in case number 1. Okay, on page 120 of your text, and I have provided this in the case on page 120 of the text, and here it is right here, are the different types of ratio analysis that you are need to work with in this case. Profitability, asset management, liquidity, and debt management. You are to select one ratio from each one of these 4 areas. Now you can select more if you want, but you don't have to. To get an A, all you have to do is select one ratio from profitability, one ratio from asset management, one ratio from liquidity, one ratio from debt management. And that's your analysis in this problem. This is on page, if you do have a text, 120, but I have provided this in the case material so you can see it. So you are to take 2 fiscal years of your company, the last 2 complete fiscal years. For most of us, that's 12/31/20 and 12/31/19. Your analysis should include at least one equation, as I just said, from these 4 sections. Here it says 5, I apologize, it's 4. Your analysis should be way of explaining to me your interpretation, how the firm has improved or declined its performance from the previous year based on this information. Is the firm managed efficiently or with efficiency? And as a potential investor, would you consider this a stock you would purchase? Then the analysis continues on the next page. Now you can use the financial statements of the company, but also you might want to go to the most 2 recent 10K filings of this company. Remember, the 10K is a public document that each company prepares at the end of its fiscal year. that gives everything you want to know about the company's financial situation. The use of charts, graphs, tables are strongly encouraged to present the data for analysis. Why? It's a PowerPoint. I don't want to see 10 slides of just printed work. I want to see 10 slides of tables, 10 slides of charts, 10 slides of comparison. It's a presentation like you would be giving to people in a lecture or in a business presentation. The good thing about it, you don't have to give the presentation. You just have to supply me the file. The student will then present an overall conclusion based solely on the overall financial performance presented about that you present about the company. Finally, based solely on the financial performance of the company as presented in this analysis, the student will recommend selling, hold, or buy the stock in the company. Based on your analysis of the data, would you recommend, if you already own the stock, to sell it? If you already own the stock, would you hold it, recommend a hold, or would you go ahead and recommend a buy on this company based on your analysis over 2 fiscal years, not quarters, fiscal years? The outline or the slides, minimum of 10 slides in this PowerPoint. You should include an introduction and brief history of the company that you have selected. Financial statement, balance sheet, and income statement with the key accounts designated in those statements. The ratio analysis by class. Remember, there are 4 classes. You would have a minimum of 1 equation or 1 analysis from each class. So that's 4. And your conclusion based on what I just talked about. So it's a PowerPoint presentation of, first of all, what's my company? Here's a history of this company. Here's its financial data for the last 2 fiscal years. Here's the ratio analysis of this company. I estimate in my conclusion that has the firm been improving its performance, or has the performance declined over the last 2 years? Is, in your opinion, this firm managed efficiently? And would you recommend to buy, sell, hold this stock? That's your conclusion. So just like you did in case number 1, where you interpreted the credit worthiness of your company, now you're determining an interpretation of the financial data that they have provided for their last 2 fiscal years, and you're going to review it.
Professor, quick question.
Yes.
If we've included this information in our case 1, we can use the same information from our case 1, or do you need us to do recalculations and things?
If you feel that information from case 1 is sufficient to answer these questions, then go right ahead.
My other question is, we are doing the same company from case 1, correct?
I have said that, yes.
Okay.
If you feel that you need to change the company, you better have a legitimate excuse and make sure I clear that before you do that. Okay. But one of the things why I selected to have the same company, because you've already seen this company, you already done a little bit of work on it, you kind of know already about the company a little bit. It'll help you better prepare for your PowerPoint format of this company. I urge you to don't have 10 slides of just typing sentences in paragraphs. You will not succeed in your grade assessment of this work. A PowerPoint is quick, bullet points, to the point, charts that stand out, data that is amplified to point to the conclusion of your presentation, not 10 slides of paragraphs. Okay? Some of you probably have experience in this in other courses. Some of you have not. That's why if you would like me to look at a draft of your PowerPoint file prior to the posting date, you could send it to me via email and I will let you know that you're on the right track on the way it's being presented. In this case, you have that option for me to review your work and let you know that it's looking like the way I expect it to look. So remember that. But please don't send it to me at 9 o'clock on Tuesday, July 20th. Give me a few extra days there. But you can send me a draft of your PowerPoint or a draft of your PowerPoint outline, however you see fit, and I can make sure that you're in the right direction of what I'm expecting in this. So you do have that option in this case to send me a draft for review. And I'm going to be grading this very similar to how I graded case number 1. And let me show you. I given each and every one of you a Excel file with key points of how I assessed your data. And each one of you in your grade center has this file with your grade and how I ranked the grade. There were 3 rankings in case number 1: risk evaluation, risk perspectives, and the overall format and presentation of your work. Grammar, did you have page numbers? Many of you forgot to even put down who your professor was in this class on the title page. Many of you did not put the date of the work. Many of you didn't even put the name of your class for this work represents. Look at the sample that I provided in the case number 1 solutions if you want to see the proper format for that. And I'm going to be doing the same assessment in this case number 2, except in risk evaluation, it's going to be financial statement ratio analysis. How did you do on that? The second area of study would be how you answered the questions. Financial performance over the 2 years, interpreted that. Would you buy or recommend? And are you stating why and giving the data why you would recommend that? Your conclusion? And the case format and presentation will still be there, representing a third of your grade. How you put together the PowerPoint. Is it legible? Is it presented professionally, neatly? I can just go to each slide and immediately see what you're trying to do. So that's how I will, you could almost call this a rubric. This is how I will be grading this work, just like subsequently, like I graded your case number 1. And I apologize, I was a few days late in posting that casework, but I have found that for me to do a proper job to set up these assessments and these spreadsheets, it takes a lot of time. And with the holiday weekend, I just ran behind in my timeline to go through and properly evaluate each one of your work and properly show you how I evaluated that. So it takes a little time. So I apologize for being a little bit late in presenting your grades. But this is the format by which I will be assessing case number 2, just like I did case number 1. Well, Maria, if you want to be picky about it, yes, I guess you could say 85 to 93 would be good. Yes. Okay. So that's how I break up the assessment. It's basically a third, a third, a third. So that's how I look at that. Just so you can refer to that in your grade center, the file I presented, and see that. Okay.
Professor, I have one question about this because
Sure.
I see what the grade score is, but when I calculated my total grade and did the division, the percentage that your scoreboard says is different than what my percentage came up to be. Is there a weighted average that you're using for?
Well, as you can see there, 35% for risk valuation, 35% for risk perspectives, 30% for case format. That's how they're weighted.
I'm talking about our overall grade.
I don't understand your question.
So in our overall grade book, we have three things that's been graded.
Oh, I see. Yes. Oh, yes. As you know, they're all, yes, in your overall grade book, you know that each one of these work are weighted. This case one was 15%.
Okay,
I believe the discussion forum for professor meeting was 5%. I believe the original discussion forum for portfolio and bio was 5%. So they're each weighted accordingly. Yes. So if you just add up those numbers and divide by 3, it ain't going to jive. It'll be probably fairly close, but it ain't going to jive with that number because I have a program there that weights that work. The greater the weight, the more that number influences the cumulative total. Make sense?
understood. Yes.
Okay. So it's kind of difficult for unless you want to figure that out yourself. But if you're really, if you want to waste time on that, go right ahead. But that's how that's calculated. Good. Good question. Thanks, Chris. That's important for everybody to know. All right. Let's move forward. Oops, wrong week. This is our week 5 file folder with our agenda this week. And here's the spreadsheet I will be using in the class this evening, week 5 capital budget analysis. Especially as I said at the beginning of the class, for any of you who need a quick refresher about capital budgeting analysis, this is a good spreadsheet to give you the basics to refresh your memory on that. And also that leads us into discussion of risk assessment for capital budgeting. I had a question earlier in the class about week number 4 spreadsheet. I will also, after class, post that week number 4 to this in-class reviews because it kind of goes hand in hand with this week's lecture. So that file folder will go here as well. So you can see that from last week's lecture. And here is that last week's lecture here to refresh our memories. Remember last week we talked about the capital structure of a company, the cost of debt, the cost of equity, and the weighted average cost of capital. We talked about that last week, and we used that discussion to determine that the cost of debt is the after-tax cost of debt, taking the tax rate of the company and taking that as the current times the current interest rate on the debt that you're mentioning. Remember, for us, the cost of debt is long-term debt. Accounts payable and accruals and working capital debt do not play in our analysis because technically they are interest-free. We're just considered about long-term debt as the interest rate. So the cost of debt is the interest rate of that debt times 1 minus the tax rate, taking out the tax rate to reduce the cost of debt to be after tax. In this case, we're paying 10% on our interest. We're actually paying 6% when we include the tax deduction we get for that interest. And as you determined in your case number 1, and all of you did a great job on this, the capital asset pricing model to determine the cost of equity, which is the cost of the equity or what the investors demand as a required rate of return for the company based on the risk in the market. Zero risk, which is called the risk-free interest rate, market risk, which is called the market return, and the company's risk, their beta in the marketplace. Combine all those into the capital asset pricing model formula, risk-free interest rate plus market premium, which is the difference between the market return and the risk-free rate, times the beta of the company or the risk of that particular company will give you the cost of equity. Based on the capital structure of the company, the percentage of debt and equity that finance the long-term assets of this institution. Notice current operating debt is not included in this capital structure formula. We can determine the weighted average cost of capital by weighting that percentage of the capital structure times each one of those individual cost of debt and cost of equity, and then adding them to total the weighted average cost of capital. This is our cost of money based on today relative to the market of risk and return for a specific company. It's also called the hurdle rate. It's called the opportunity cost. It's the cost of your money today, not tomorrow, not last week. As of today, that's your cost of capital. So this is that. Yes.
Sorry, I don't mean to cut you off, but I'm glad you mentioned that, because that was part of the reason why I didn't include my WAC on my report. Is I found it on 2 different days, and 2 different days it was a different number, but you just explained why, and it's because it changes every single day.
Yes, ma'am.
So I was like, wait a minute, which number do I use? Which number is he gonna verify? It was a little different. So that's why I left it out. But now I understand why. I probably could have still included and just said as of whatever date, what the number was.
Exactimon. That's why it was optional. That's why it was optional in that case. Okay. Next week, or in 3 weeks, you're going to be doing case number 3, and you're going to be doing a capital budget analysis where you're going to calculate the weighted average cost of capital based on the data I give you and perform a risk analysis of an investment for a company. That'll be a spreadsheet case, but that's in our next case, number 3. Okay. So what is our cost of money? And at that present time, why do we do it at this present time? And that was a good point of Chris. Beta is calculated every quarter. Right? Market return is calculated generally once a month. But the risk-free interest rate is given every single day of the year, of the business year. It's the current yield on a 10-year United States Treasury. It's given every day. It changes every day. So the relationship of your risk to the market changes every day. But what the weighted average cost of capital says, okay, as of today, this is where we stand, and this is how I'm going to do my analysis. And what is that analysis? It's the capital budgeting analysis that looks somewhat like this. This is our spreadsheet for this week's class. This is a capital budget analysis for a 10-year project. Kind of looks familiar a little bit. It's determining the cash flows generated off an investment of $1 million over its depreciable life of 10 years. We don't go 15 years. We don't go 5 years. The bean counters, or the accountants, and the IRS tell us to do a capital budget analysis. It's based on its depreciable life. Why? Because the depreciable life generates cash flow. Notice depreciation is added back in as positive cash flow in this project. It's an expense, reducing our taxable income, but at the same time, it's added back in as a net project cash flow because it's a non-cash expense. We add it back in. But you can only do that over the depreciable life of the asset. This is one of the reasons why many companies get audited. They say an asset is depreciated over 15 years when in fact they depreciated over 10 years. The IRS says, wait a minute, dudes, legally you can only do 15 years. You're overstating the results of this project. You're going to have to make up that tax. Many companies get in trouble this way. Let me mention a few. Enron. Interesting. They're no longer in business. Let's mention another one. The Trump Organization. It won't be long till they're probably out of business too. You can't do that. You can only go by the depreciable life that's agreed upon by your public accountants and the Internal Revenue Service Code. But we don't have to worry about that because we're just going to be given that information and we sort that out for ourselves. We don't have to determine whether it's legal or not. We just know what's the depreciable life. And notice we determined that this investment of $1,060,000 today, year zero, is generating over 10 years $2.417 million of cash flow. Not profits, cash. This is the accounting profits, $1.322 million. That's their accounting profits. Expense sales minus expenses less tax. That's their accounting profits. But their project cash flow is about $1 million more than that because it includes depreciation, working capital, and the disposal value of the asset at the end of this life. How much I get for it at disposal. Even though in real world, we're probably not going to dispose of it at the end of 10 years. But we can't depreciate anymore. So cash flow wise, we dispose of it. We dump it. We sell it for scrap. And whatever we get as a return on that is designated cash flow estimated in the final year. So once we determine this accounting profit and net project cash flows, we compare the $2.4 million received over 10 years to the investment today of $1,060,000. $1 million is the purchase of the asset that generates this return, and the $60,000 is upfront working capital to get the project going before we actually start production. It's called working capital. It's based on a percentage of revenue. Again, I'm assuming you guys all have a history and know about this. A lot of you are thinking, holy crap, I forgot all about this. I'm in big trouble. No, you're not. That's why I'm giving you this cheat sheet. You got this. This is the template. You see it. No worries. You can get refreshed with this. Remember, capital budgeting is a series of 6 steps. How much are we going to invest today? What's its depreciable life? What is the revenue and expenses we plan on estimating generated off that investment? What is the return going to be in dollars, NPV, percent, internal rate of return, ratio, profitability index, and years, payback? What's the return in dollars, percent, ratio, years? And if all that looks like it's positive, profitable, then we do a risk assessment and determine whether this data that we've put together as estimates over the life of the asset is legitimate. Is it real? Or is it a bunch of phony baloney pulling numbers out of the air? You do a risk assessment based on this data. This is the new material we're talking about in chapter 10 and 11 in our textbook. This is the new material that for many of you is finding out in this class. The risk assessment of these first 5 steps. I can't tell you how many times I've sat in meetings at a variety of different institutions where they say, oh, we're going to invest $500,000 in this project, and we think over the course of its depreciable life of 5 years, it's going to pay us back $10 million in profits. Really? A $500,000 investment over 5 years is going to pay back $10 million in profits, cash flow? Prove it. Well, this is what we plan on selling it for. These are our expenses. This is our depreciable amount. As you can see, we're generating. Who came up with these numbers? Did you just pull numbers out of the air and say, oh, yeah, this is what we would like to happen? This is what we hope and pray will happen. Are they legitimate? And many times, this risk assessment, the last step, says these numbers are bogus. Boys and girls, you better go back to the drawing board. And this is why we study it at this level of your MBA. These are the decisions you all in management and strategic decisions you have to do. The bean counters and the treasurer's office put these analyses together. Then they bring them to your desk, your committee, your board, and say, we recommend that we go ahead with this investment at these costs and these generated estimated profits. And you, as the leader, as the strategic decision maker, have to say, what are the risks in these numbers happening? High, medium, low? What happens if we have an earthquake in California and we can't produce this product for 6 months? What happened if the economy has another pandemic in the next few years and we can't sell anything for a year and a half? Are those numbers built in this analysis? No, because the pandemic is once every 100 years. Who says it's going to happen? Who says something else is going to happen? What happens if our leadership team goes on an airplane flight to China to develop some new business and they crash and our whole management team is wiped out? What do we do then? Oh, well, we all fly on separate airplanes. Oh, okay. All right. That's a risk assessment. That's there. You're thinking a little expensive, but that's okay. But these are the questions and these are the scenarios that you all, as strategic managers, have to think about. And that's why we're going through this exercise. It creates strategic thinking. If you work for a boss that you can put anything in front of them and they say, oh, yeah, let's go ahead with this. This looks good. I'd be a little bit scared of that boss. A boss, a strategic leader should question, how did you come up with these numbers? What was your thinking behind these numbers? How did you determine inflation rate in this analysis? What happens if our risk changes in this company over the next few years? How does that affect the results of this project? These are the strategic questions that you, getting paid the big bananas with an MBA degree, need to ask. And that's why you're being hired to do that position, to ask and assess those questions. Because if not, the company can get in big trouble. Just ask Coca-Cola about that in the 1980s. Just ask Ford Motor Company about that in the 1970s. Just ask General Electric about that in 2000s. Markets, conditions, customers, consumers change. And if you don't build the risk of those changes into your projections going out in the future, you're not earning the money they're paying you at this position. And then you're going to get canned. So that's an important concept. These are the 6 steps of capital budgeting. You've probably done all these 5. Now we're doing the risk analysis, and we're going to talk more about this in detail and looking at examples of that in next week's class. Next week's class is, I like to call it in the 6th week of this class, article week. I give you articles from the real world to read about. I give you examples of risk assessment in a capital budget analysis. I call week 6 strategic thinking week next week. This week, we're refreshing ourselves on how these numbers come to pass, and then we'll talk about strategic thinking next week. Also, I'm giving you an extra week to do case 2, so I don't want to burden you or bog you down with any real new material next week, because I want you to concentrate on that PowerPoint case that's due the week after next. Okay. Remember, we talked about weighted average cost of capital last week. In this capital budget analysis, notice that the weighted average cost of capital for this project is 8.83%. Here's the calculation of how that came about in this problem. They have a 60-40 capital structure in this company. Their tax rate is 30%. Their interest rate on the long-term debt component of this company is 9%. Thus, their after-tax cost of debt is 6.3%. The risk-free rate is 2.5%. Good God, what country is this in? The market return rate is 10%. There's the company's beta. Here's their capital asset pricing, cost of equity, 12.63%. You weight that by the capital structure of 60/40, you get a cost of capital today of 8.83%. And that is used as your, let me make this a little bit bigger here. That is used as your discount rate to determine NPV. It's used as a basis for determining your profitability compared to the internal rate of return. It's telling you your discount rate for the money going forward in this company. Notice there's no interest expense in this analysis. There's variable costs, there's fixed costs, there's depreciation, there's tax. There's no interest expense. The interest expense is this right here, your discount rate of 8.83%, calculated by doing this WACC analysis here based on the capital structure of the company in relationship to the tax rate and the risk in the market of this company. So the base analysis, after we calculate and determine these net project cash flows, we use the four main functions of return on investment. It's really three, but I'm throwing profitability index here because sometimes some people like to use it. Not too often, but they like to use it. But the three main determinations of whether an investment is profitable or feasible is net present value, internal rate of return, and the payback in years. How long does it take us to pay back our investment based on our return of cash? So to refresh your memory, the net present value method is taking the discounted cash flow and comparing it to the net investment in year zero. The discounted cash flow is taking the 10 years of cash and discounting it back to today at 8.83%. That's $1.51 million. The $2.4 million in cash received over the 10 years is actually worth $1.5 million today by discounting it back to today's value at 8.83%. And then we compare that to the investment. It's profitable. In today's dollars and today's risk, at these projected cash flows, we're making $451,000 in dollars. The internal rate of return is taking this cash flow and the investment over the 10 years and determining what is the return in percent. A little bit over 17%. And why we know that is good, because with our cost of capital being 8.83%, we're almost doubling it in return. The profitability index is a ratio of the discounted cash flow to the investment. Hopefully it's always over 1. And the payback is a straight dollar payback over the life of the project. When do we recoup our $1,060,000? 1, 2, 3, 4.94 years. Almost a little bit under 5 years payback to get our $1,060,000 back over the course of this project, which is good. You want to generate a profit in dollars. You want to have your internal rate of return quite a bit north of your weighted average cost of capital, and you want to have a payback in less than half the time. Preferably, if you're Apple Computer doesn't do a project unless they get their money back in 2 years or less. University of La Verne does not invest in a new dining hall unless they know they can recoup their investment in 3.5 years. Chevron Oil Company does not invest in a new oil platform in the Gulf of Mexico unless they get those expenses back in a year and a half. If it's not a year and a half, Chevron says, find the numbers, we aren't giving you the money. If Apple Computer invests in a new iToilet, yes, they're thinking about an iToilet. Can you believe that? And that iToilet doesn't recoup those expenses and to give you a profit over 2 years, they're not giving you the money to invest in an iToilet. Ford Motor Company will not invest in a new car factory unless the internal rate of return is at least double the cost of capital. So these are standards that companies set in their cultures, in their strategic thinking that drive their decisions of investment. Right now, many companies are thinking about bringing products to market in 3 to 5 years. Well, we don't care about that now. Oh, yes, you do. Because right now they're determining whether in those next 3 to 5 years and going out further, is that investment in those dollars going to generate the return that they need to satisfy their investors, their board, their customers as a return on that investment? If not, they go back to the drawing board. Give you a perfect example of this. In 1988, Steve Jobs was given the final numbers of the very first iPhone, an investment of $350 million. And the capital budget analysis for that investment of $350 million over the depreciable life of 15 years was to generate the cash payback in 7 years with an internal rate of return of about 18%. Steve Jobs and his board says, we ain't doing it. We're not getting our money back quicker. Remember, guys, I don't pay dividends to our shareholders. They want profits fast because when we get profits fast, our share price goes up quicker. That's the only way they're going to make money in Apple because I ain't paying dividends. I'm saving those dollars for investment. So Steve Jobs went back to his financial managers at Apple in 1988 and said, guys, this ain't cutting it. I want to pay back in a little bit around 2 years. I want an internal rate of return of 25%. If you can't do that, then we're not investing in the iPhone. And guess what they did? Steve Jobs got on an airplane in the beginning of 1989 and went to China and negotiated to build the iPhone in China. By doing that, they turned a 6-year payback into a 1.5-year payback by building the iPhone in China instead of Palo Alto, Cupertino, wherever. Why? It was a hell of a lot cheaper to build it in China. That's how iPhone became a staple in the communication industry. They weren't going to invest it until they got their money back quicker. Why did they want to get it back quicker? Because Steve Jobs was under pressure to develop a second iPhone, a third iPhone, to develop Apple Tunes, Apple Watch, Apple TV, Apple this, Apple that. He needed the capital back quicker so he could go and build these new ideas. That's why the capital budget analysis told him that we got to build this sucker in China. Every company does this. It's huge. And if you're going to be in corporate financial management, you got to know this. Okay. That's a pretty good review. We just did Business 330 or Business 500D that would take them about 6 weeks. We did it in about 35 minutes. So again, what I urge you to do over the next week, even though you're going to be working on case number 2, I urge you, if this is a little bit unfamiliar, take a look at this spreadsheet. take a look at the process to refresh yourselves of capital budgeting. Take a look at what we talked about last week, how to determine our cost of capital today in relationship to our tax rate, market rates, market risk, and our own risk and capital structure in the market today. And how to put budgeted expectations on paper to determine returns over a period of time called a capital budgeting analysis. Then, this is what we're doing next week. Then we're going to take a look at risk analysis. It's called scenario and sensitivity. Don't want you to spend a lot of time on this week unless you do have the time, but this is what we're going to concentrate on next week. Here, this is what is called a base analysis. A certain amount of investment at a certain selling price. In this case, the selling price is $20 a unit over a particular 25,000 units every year sales. A proposed inflation rate of 2.5%, 2%, and 1% at various levels. A tax rate that doesn't change over 10 years. A working capital rate that doesn't change over 10 years. A lot of basic assumptions that we hope will happen. The risk analysis takes a look at what if certain things change in the next 10 years. What happens if the economy gets stronger and we can sell more than 25,000 units a year? What happens if the economy becomes weaker and we can only sell 12,500 units a year? How does that affect our profitability? What if key variables from this analysis, selling price, variable cost per unit, our cost of money, what if those change during the course of the 10 years? How does that affect our profitability? Notice if our selling price is cut by 15%, notice how low profits are. But if we can sell our product for 15% higher, we can make a ton of money. Welcome to the world of high-tech retail. Apple doesn't have to sell that many products because they can charge the top in the market. People are willing to pay anything for an Apple product. Whereas Samsung, Google, some of their competitors have to lower the price because their customers will say, I'm not paying that for that type of that product. You're not Apple. You still make good products, but I'm going to pay you this for that. Different companies have different cultures of products. That takes a look at that. What happens during the course of this project that we have a new labor contract and our labor costs go up 15%? How does that affect our profitability over time? What happens if our risk increases during the course of this period and our cost of money goes up? What happens if inflation rates heats up and our cost of money goes up? How does that affect our profits? And this is called a risk analysis based on the sensitivity of key variables of this project. The steeper the slope, the greater the risk of that variable. Notice here, selling price changes, that has a greater slope. That means the price of profitability changes dramatically. Whereas variable costs and WACC are a little bit flatter lines, those changes in those prices up or down has less effect on profits than selling price. Seems pretty basic. But this is the analysis that a lot of people, banks, board members, investors want to see. Okay, I'm going to buy stock in your company because you're going to be investing in a new plant. You need the capital. But prove to me that the risk of this investment is going to pay off for me, the stockholder. Show me the good, the bad, and the ugly of this potential investment, into the future. That's what this is all about. When somebody comes to me in the real world and says, Rick, we'd like you to be an investor in our company. All right, show me your business plan. I take a look at their business plan and I go, hey guys, your business plan only goes out 3 years. I plan on, if I give you my money, I'm planning on hanging on to this as a stock investment for 10, 15 years. It's an investment for me, for my family, for my kids. Why aren't you, what's going to happen after 3 years? What's going on? Well, we don't have the numbers to do that. Well, if you want me as an investor, you better show me some numbers. 3 years ain't making it. Also, if you're doing it 3 years, if let's say I decide to loan you the money and you're going to pay me back in 5 years, what's happening in years 4 and 5? Shouldn't I be a little nervous? You're going to pay me back in 5 years, but you only show your projections out for 3 years. What's up with that? These are things that managers and strategic thinkers have to think about if they're going to go out into the bond market or out into the stock market and raise capital. These investors are going to be asking these questions about the future and whether this is a risk for them or not. We'll get more into detail on this next week. But the thing now I want you to concentrate on is just refreshing yourself with this basic cash flow projection, return on investment, and how this all fits in to determining an investment today of $1 million is going to generate a discounted return of 17% over 10 years. Or that this investment of $1 million today is going to generate a payback of all the costs in a little bit under 5 years. Or that this investment of $1 million is going to generate in real numbers compared to my investment today, almost $500,000 in profit return, including all the expenses and all the costs. I'm making $450,000 on this investment. That's our review today. Making sure you understand this. And I give you some reference pages from the textbook if you have the text, and I'll update these. This is for the old edition. I'll update these before I post it to Blackboard this evening. And then next week, we look at the final tab in this spreadsheet to do a risk assessment of this analysis. But we'll concentrate on that next week. Because in case number 3, which will be distributed to you on, where are my notes? On July 21st, I believe. July 21st? Yes, on July 21st, due July 27th. You'll be doing this spreadsheet as that case. You'll be doing this analysis, a risk analysis. I'll be giving you this. I'll give you the base analysis. Your job in case number 3 is to do the risk analysis and tell me, is this still a worthwhile investment? That's case number 3. I'll give you this, so you don't have to worry about calculating any of this stuff. But you'll have to worry about calculating this. And we'll do that calculation next week. But this week, review it. Make sure you bring up to speed about this process of capital budgeting. How much are we investing? What's the depreciable life? What type of estimates are we for revenue and expenses? What's going to be our net yearly cash flow? And determining the weighted average cost of capital, what is our NPV? What is our rate of return? What is our return analysis of that project or that investment? And then we'll do the risk analysis next week. Now I want to go back over a couple more things. of case number 2, which is on the table this week. Let me bring this back up. Remember, the key thing in our class that I said from week 1 was we're going to develop you to think. Think strategically. A lot of you did that very well in case number 1. You looked at the numbers, you looked at the evaluation, and you explained what the company is going to look like in the market. You looked at what the company's organizational risk is. You looked at what the company's risk to various different types of factors. You interpreted it. You put the numbers, but then you thought and explained something. Same thing holds true in case number 2. You're going to take that same company and you're going to look at the numbers in 4 key areas: profitability, asset management, liquidity, and debt management. And then you are going to interpret that. What does it tell you about this company? Is this company running on full cylinders? Or do you see some weakness in these numbers? Do you see some projections or some possible areas of concern in this company? And one of the things you might want to use is your analysis from case number 1, where you looked at the risk involved, their credit rating. That will imply a little bit as background to these numbers that you're doing an analysis of. Here's a key phrase from this case. In the overall presentation, the key concept to remember is that you should focus on the why or how come or what caused, not the what was of the analysis, of the ratio of the trends you're seeing. Remember, trend analysis is comparing 1 year to the next. You're doing a trend analysis of 2 years. And in the real world, I want to apologize. If this was a real solid case, I would probably ask you to do 3 to 5 years trends. But we just are limited for time. We're limited for what we can do. And so I cut it to 2 years, which is not really give you a real good solid analysis, but it's good enough. And I'm willing to do that. Why, how come, what caused? The what was the financial numbers. Now you're going to interpret it. What does that tell me? What does it tell me about the stock, whether it's a good investment? What does it tell me about the company's management style or efficiency? What does it tell me about the company's relationship to the market? And I'm going to tell you this right now, which I shouldn't, but I'm going to. If you want to get 100 on this, it's not mentioned in any part of this case, but you want to compare this company to their competitors in the market. What does the trends look like to one of their major competitors? Take one of their major competitors and compare their numbers to what you have. What does that tell you about the management of this company compared to one of their competitors, their main competition? Notice that is not said at all in this case, but it's a legitimate review of these numbers. Okay, this is our performance over the last 2 years. This is what it says. Okay, I can write about that. But if I really want to find out what's going on here, wouldn't I want to compare it to the industry average or a main competitor? It might look great here, but if I compare that, let's say this company is Coca-Cola, and I compare it to Pepsi, and Pepsi's kicking our ass. That tells me something. So that's what I mean by 100% work. It's not ask of you. You'll get a 99, 98 if you do it just as it says there. But if you want 100, that's what you got to do. Well, Mr. Hassey, that's not fair. I can't read your mind. Oh, yes, you can. Listen, you've been in college now for over 20 years at all various levels. Figure it out. That's called strategic thinking. What would blow Hassey away if I figure out something here? Now you're thinking like a leader. Now you're thinking like, I should pay you $300,000 a year. That's what those people think. See what I mean? I'm not trying to be a snob here. I'm trying to put you in a position where you go over and beyond because that puts you in a marketable position in your career. You think more and better than your competition, the people who are after that job that you want. You're a better leader. You have more respect within the company because you're always thinking at a different level than everybody else. Wow. Yeah. It drives me nuts when I sit in a meeting with people making $500,000 a year and they're not thinking. They just think because they're there and they're in a position that they manage 400 people that they owed $500,000 a year. If I was a board member, I'd kick their living butts and say, "You're not earning your money at all. You got to think above that. Earn that salary. Earn that leadership respect." That's what we're trying to do here. I know it's being a kind of a pain in the neck, but it's putting you in a position down the road to be better than your competition. And that's the bottom line of an education. I want to create myself to be better. And that's what we're doing here. So think about that as you prepare these. I have my office hours this Thursday night. If any of you want to talk about PowerPoint, if any of you want to talk about this case, feel free to show up at 6 o'clock. The link is in your syllabus. The link is in Blackboard. If you want to, I'll be there if you want to talk about this. Mr. Hassey, I haven't done a PowerPoint in years. Can you give me a sample? No, I'm not going to give you a sample, but I'll tell you what I'm looking for. All right. And also, since this is a 2-week assignment, I'll have my office hours next week. We'll have our class next Wednesday night. You can ask me questions relative to this case next week in class after working at it, looking at it for a week. But ladies and gentlemen, trust me. Don't say, "Oh God, I have 2 weeks to not do this. Oh, I'm going to just put this aside and I'll worry about this on July 25th or on July 18th or wait out just before it's due." You'll forget everything we've talked about here and you'll blow it. So just remember that. Start thinking about this now. Just gather the data. Go and find their 10Ks. Go get their financial data over the last 2 years. Just get all that data together. Now you got it. Now you pick up later now that you got all the data. Then once you have all the data, do the analysis and then say, would this look good in a chart? Would this look good in a graph? How can I present this to make it look good? And then once you got that figured out, then you come to the conclusion. What does this tell me? And then you're done. But you've done it in a systematic way that will provide success in your presentation. Okay. Anybody have any questions on any of this material that I've talked about this evening? You got to let it sit in a little bit, I know.
I just got a question. Do you ever dock us for going over? And what I mean by that is that some professors don't, if they say minimum 10, maximum 20, and somebody do 25, they dock them for the extra 5.
Then those professors are idiots. Really? If
Yes, I've had it happen twice.
well, I again, quote me, they're idiots. If I have an employee and they want to do more and show me more thinking, more analysis, I'm going to say, no, I don't want you to do that. Really? Get the flying frig out of here. I'm sorry if I'm not trying to demean my colleagues, but really, this program is designed to bring out the best in their students, not limit them to their thinking. I mean, give me a break. So no. Now I'll come down on your butt if you give me like 5 slides on this work when I said 10, because in my opinion, to do an adequate job, you should do 10 slides. Remember, you're going to have 1 slide for your references. You got to have one slide for references. So that leaves you with 9. And then you're probably going to have one slide as your title page, as your introduction. Now you're down to 8 slides. Then you're going to have another slide for the history of the company. Tell me a little about it. Now you're down to 7 slides. Next thing you know, oh yeah, geez, I'm going to need more than 10 slides. See what I mean? I just gave away the presentation. God, what an idiot. Sorry. That's good. You guys deserve it. But that's what I'm looking for. Okay. And I'm giving you plenty of time. And as I said earlier, put a draft together and send it to me. Hey, Halfman, how's this look? Well, I like your presentation, but maybe you should concentrate a little bit more on this. Or, I like the numbers, but it's presented a little bit too busy. I can't, it's difficult for me to read. What are you trying to say here? So if you want to do that, please feel free to send me a draft and I'll review it. And this has nothing to do with the grading. If you send me a draft and it's a disaster, I don't write down, well, Kevin Ramirez, this was a disaster. It's going to affect his grade. No way, that doesn't work. And if you want to give me 30 freaking slides, give me 30 slides. Please do. I don't mind reading them. Remember, I'm a geek. I love this stuff. This is my life. I'm into this. You're probably going, good God, this guy needs some help. But seriously. So Chris, and I'm sorry I'm being a little bit of an obnoxious jerk on that answer I gave you, but no, take as much effort as you want to give me. As far as I'm concerned, you're a better student for it. Okay? Okay. Any other questions?
Excuse me, Professor.
Yes,
The 10Ks that you're referencing, is that the same financial statements that you can pull off of DB and Hoover, or?
Yes, exactly right. I'm sorry. I should explain that. I'm sorry. Sometimes I think when I give the lingo, you guys can read my mind. What's he meaning there? A 10K financial report is something that's in DB Hoover's, but you can go to the company website to investor relations and download. Don't print it out. 10K reports are about 400 pages long. All right. But 10K reports are a public document that's shown the world that a company as a public corporation has to file after their audit is done every fiscal year. Okay. And it's a statement of everything financial about the company, not only financial statements, but who gets paid what, who they owe all their money to, do they have any lawsuits against them, where do they do business, what are our financial ratio? Again, it gives you everything. It's a good one solid piece of information that you know where you can find all this stuff. Now, if you want to just reconstruct it from other sources, go right ahead. But the 10K is a pretty cool resource about looking up. Now, it's big, it's long. They give you a table of contents. You can look this stuff up in it. But if you don't have much experience with it, you're probably going to say, what the hell is Hansi getting me into? He's letting me download 2 400-page files, and now I got to go through all this? What the hell is this? Well, GRADUATE. Graduate study. That's why we're here.
Professor, can I just add one thing to that? The 10
Yes, ma'am.
will actually give you the 2019 and 2020, as well as for some of them, they'll go all the way back as 2016. It'll give you the numbers, the figures, all on one file. So you don't have to really go looking for multiple reports. They're all there and they're already compared for you on the 10K.
Sometimes some companies do that. I don't want to say that every company does that, because they don't. But you're right. A lot of times it's all collaborated. But remember, you guys only have to concentrate on 2 years. Just worry about 2 years. That's all. Because then this will turn into a 50-slide presentation. So I don't want that. We got other work to do in this class. So keep this very minimal. Okay. But again, nobody has taken advantage of it yet, but come and see me Thursday nights. I'm sitting here, I got a nice cocktail. I'm waiting for your calls. And so come and see me on Thursday nights if you have any questions or want to talk about something. Okay? That's why that's there. You don't have to call me in advance. Are you gonna be there? I might not, my computer's on. See, this is my office hours computer, my little Mac, and it's always on. So if a student is there, it sends me a little bell, bing, bing, bing. You got a student, get to work, Hassie, and I'll come on. So I'm here if you come on. Any other questions? Take a look at your grade center. We've now completed roughly a quarter of the grades of our course, about a quarter, 30%. See what your grade point average is now. Make sure you understand that. Chris asked some very good questions earlier. That's good. I like to see that. I like students paying attention to their work. It's going to go up by another 15% after case 2. So know where you stand, know what you have to do. Everybody's got some pretty decent averages right now. But don't rest on your laurels. Trust me. Keep to the grindstone. Keep studying. Keep working. And everything will pay off in the end. So make sure you know where you stand in the class. Florencia, smile. It's not all that bad. All right, good. Mr. Usher. What's going on? Who do you got in the Stanley Cup? Tampa or Montreal? What's going on, Robert?
It's Tampa.
Get the hell out of here. Maria, who do you like, Phoenix or Milwaukee in the NBA?
Phoenix.
Got a girl.
Yeah.
Octavio, Mr. Ortiz, who do you like in the runoff election? Newsom to get kicked out of the governorship or to stay on? Let's get a little political here. Governor Newsom to stay on or kick him out? What do you like?
Stay on.
All right, there he is. All right. That's the end of the questioning for tonight. If that's it, I'll post this video a little bit later to all my online students who are listening in on that. One of the things I forgot to apologize. I did not do an introduction video this week, and I'll tell you simply why. I was too friggin' lazy, and I apologize for that. I did not earn my pay this week. I get paid $12.75 an hour. I did not earn my pay this week, and I apologize. You will not see another week with no introduction video. I apologize. I was bad. That's what I get for spending my holidays at a family reunion for the first time in 2 years. We got all my knucklehead family members together, and it took all my time. So I apologize. No excuses, but you'll have an introduction video for next week. All right, everybody. You might not see me next week because here is the winning lottery ticket for tonight. If I win this week, adios amigos, we're done. You'll have to find another faculty member because I'm hitting the highway if this comes in tonight. So don't count on it, but you never know. $70 million, adios amigos. All right, everybody. That's a lot of working capital that I can invest. Have a great week, everybody. Glad you're
Good
here.
night.
Hang in there, and maybe I'll see some of you on Thursdays. If not, email, send me your drafts. Once you start working on the PowerPoint, I'd be happy to look at them. Have a great week. Stay cool. Adios.
Take care.
Thank you.
Thanks,
Bye-bye.
everybody. Have a good night.
Thank you.
Thank you.